When you think of your investment portfolio, how diverse really is it? When you start breaking down what is in your 401k, what is in your IRA, you want to make sure that you have a lot of diversification, which is what we're going to be going over in this video today. The first one we look at when it comes to the diversification is asset class diversification. This breaks down stocks, bonds, and cash that is spread into your portfolio. This means that you're not sitting on 100% stocks, you're not sitting on 100% bonds. Now you'll notice with some of the age-based programs or some of the target age dates that we see from Vanguard and a couple other companies, that they are a majority very heavy in stock. Now this will switch depending on how long. So if you're looking at, let's say for instance, a 2065 plan, the chances are, because it is many years out, that the majority of it is going to be in stocks and you're going to have a very small part in bonds, very small portion of cash. Now as you get closer to retirement, so let's say you're in a 2030 plan, and right now we only have a couple more years until the year 2030, chances are the stocks are probably a little bit lower, and the bonds, they have started to pick up to yield that income every single month. Now make sure, guys, again, that you're really looking at the asset class diversification and making sure that you do have it in there. But there are a ton of ways to diversify. Also, a geographic diversification. It removes or moves your investments, essentially different regions, different countries, to reduce the risk associated with a specific location. Now, we see this a lot where if all of your investment portfolio in its entirety is all US based, you have no international stocks, you have nothing that is outside of the United States. If something should happen here, if that is where all of your funds are at, the chances are you could have a very high risk factor if something does happen to the market, where we could see some stability in other countries. Now, locally, we've seen, kind of COVID affecting the world. And as of now, guys, we've seen the United States kind of in a very good spot economy wise as we continue to get inflation under control. If you look at other countries, if you look at other regions, there are places where inflation is just burning up every single penny, where the currencies are almost folding. It is kind of crazy to see, how much stability we really do have here in the United States in comparison to some of the other countries. And of course, we're not number one by any means, but we do have a well sought after and well diverse income stream that we have with the sectors within the stock market. Next one we look at is just that, guys. It is the industry and the sector diversification. This is super important, and this is especially important when it comes to some of the sectors such as technology that can have a really big high ups and downs, making sure that you are spreading and diversifying that portfolio. Again, talking about it all the time. This is the reason I invest in the VOO. It actually takes all of the sectors of the indexes the S&P 500, really diversifying across every single sector. So if you have a certain sector that underperforms or has something catastrophic, like we've seen with the banking industry, with a couple of banks failing, a lot of the sectors or that the financial sector did take a pretty nice hit when that did happen, but it was picked up by a lot of the tech sector and a lot of the other places that really made a difference, which is the reason if I was solely invested into one specific thing, let's say I was 100% into technology's seen a 30%, probably 30% plus decline in 2022, which could have a massive effect on your returns when it comes to your investment portfolio. Number 4, we look at the market capitalization diversification. This is breaking it up. Now, a lot of 401k plans that you have with your employers do have the ability to do this. So this breaks it between large cap, mid cap, small cap to really balance the risk and the potential rewards that you can actually get from the portfolio. If you're putting everything into large cap, again, we might not see, and we do not see the growth when it comes to large caps, just because you're talking about massive companies. You're talking the Apples, the Teslas, the Googles, the Walmart, all of the large companies that are in the United States are large cap that are trading. And I believe, if I'm not mistaken, it's north of 100 million. Maybe it's a little bit higher. Maybe it's 100 billion that I'm thinking. But then the mid cap and the small cap, those are usually the sectors that can have a tremendous amount of growth. So again, depending on the cycle of the economy and where we're at, mid caps and small caps, it's good to have a good diversification. Now, overall, when I look at kind of a balanced portfolio, you might do 40% in like the large caps, you might do 20 in the mid caps, you might do 20 in the small caps, bringing you up to about 80%, and then looking at possibly, if your 401k allows, doing some international, doing something a little bit more riskier, maybe a little bit more outside of the box. Now, I'm not an investment advisor, guys. I am just speaking from experience in working with multiple investment advisors, seeing how they really broke out the large cap, the mid cap, and the small cap. Really, most of them will bring it to 80% or 90%, and then go with that rest of that into that international. Number five, we get into the risk tolerance. This is super, super important, guys. When you're taking assessments, when you're doing investing, not only do you have to do your own research, but you also have to know that there is a fundamental risk with the portfolios, guys. They are going to go up, they are going to go down. It is not about timing the market, it is about time in the market. Really, if you live by that, if you're looking at retirement, if you're 20, looking at 65 in retirement, you have 45 years to go, the ups and the downs, really taking it. That means at a younger age, you definitely want to take on more risk, because if something does happen where you do lose a considerable amount of investment, you do have a long time to make up. And even if everything goes south and you lose all your investment for whatever it may be in, which usually doesn't happen, but you do have time to make more money and to reallocate and reinvest to really build up. Live and learn, guys. It is really one of the big ones, but make sure you're not taking unnecessary risk, and you're not taking risk with a huge part of the portfolio. Personally, when I look at my cryptocurrency, I know it is a high risk and I'm okay with that, but I allocate about 5% of an investment portfolio into cryptocurrency. So it does keep it very minute, where even if the Bitcoin and the Ethereum does, go down a lot, up a lot, whatever it may be, guys, I still have that 5%. That way I know my risk tolerance is really good. Number six, we look at the correlation analysis. This is really looking for the historic relationships between assets, because a lot of them do not move in tandem, guys. A lot of times, if we see a big decline in the stock market, we'll see an increase in the bond market, because money is moving hands. That is exactly what was happening in the crypto market, where a lot of people were pulling money out of the stock market, were pulling money out of investments and moving it into cryptocurrency. And then, of course, we've seen the flip side of that, where a lot of people were taking money out of cryptocurrency, which drove, of course, the price of Bitcoin from like 62K to like 30,000. I think at one point it was even down to 18, because they were selling and taking all of the money out of the cryptocurrency, because it was and had a much higher risk. Number seven, we look at the investment style diversification. This is another one, guys. Again, big fan of Dave Ramsey. Shout out to him. But when you look at the different styles and the diversification, you want growth stock, you want value stocks, you want dividend stocks. There are, and these do perform in a very different manner. I know he is a big fan of mutual funds, but again, he says put 25% in a growth mutual fund, put 25% in a value. He kind of breaks it down into 25, 4 stacks of 25 to equal that 100% of how it should be invested. Now, again, me personally, not a huge fan of the mutual funds because of the costs that are associated with them. I guess when you get to a certain point, it doesn't really make a big difference. If you're investing 10, 15, $20 million, if not more, the fees kind of come minimal at that. But if you're looking like a majority of us, where you might have 10, 20, 30, $100,000, you're not in the millions. You're not paying someone to manage everything that is going on, which is why I rely on my ETFs. I love the ETFs, and I always will. And number eight, regular rebalancing. This is one that I wanted to spend a little bit of time on, because when you look at the CEO of Vanguard, guys, he released a publication. I believe it was a speech that he was going about the rebalancing, and how technically you should never have to rebalance a portfolio, because essentially what you're doing is your investments that are doing incredibly well are going to grow faster than investments that are not doing as well. So essentially what the rebalancing does is you're taking these investments, because let's say the large caps at 40% are doing incredibly well. It grows that large cap to 45%. The rebalancing act is going to sell that back down to 40% to make up what the mid cap and the small cap is not doing, essentially. So he said, without the rebalancing aspect, you can let the large cap run, and we're just going to let that run, because that is the sectors that is going to perform. Over the long term, the mid cap and the small cap, if they are underperforming, they will either have a smaller percentage, or they will start performing at a point that they can catch up to where your large cap is. And again, the rebalancing, I choose not to rebalance. I really let the portfolio, I set my portfolio, I put money into my portfolio every 2 weeks. through automatic payroll deductions. Really have to go ahead and optimize that, doing it automatically with the allocations. And then it is broken into what I have it invested into. And again, I do not do the rebalancing personally. Number 9, we get into the income versus the growth. This is one of the ones, guys, when you look at the bonds, when you look at investments that generate income, this is talking about the dividend investing, the bonds, those versus those that really focus on the capital appreciation, growth stocks. It really is different financial goals, but you can have both. And that is what I think a lot of people really get stuck on. When you look at, let's say, the SCHD, the Charles Schwab dividend fund, a lot of people really support it. A lot of people put a lot of time and effort into it. They said if you want a dividend fund, it's really the only one that you need to be paying dividends on a regular basis. But if you can mix that up, guys, so I have the VOO with the S&P 500, dividend yield really not that big, but if I'm putting 30% of a portfolio in there, I am good when it looks at the large cap, because of course it is the 500 largest companies in the United States. I put, 20% in the SCHD. With that, I do get a pretty good dividend yield that is going to grow over time. And I also put some in a couple different places, including the cryptocurrency, in the REITs, possibly looking at Masterworks, things of that nature, to really allocate and balance out that portfolio. And the final one that we look at, guys, is the alternative investments. Exploring the non-traditional assets. This is where you get into real estate, when you get into crypto, when you get into fine art, when you get into commodities. There is a big upside, and there is a big downside when it comes to a majority of these, guys. So make sure, again, that you're doing your research before you go in here. So I hope that helps with the diversification of a portfolio, really breaking it down as we continue, guys. This is the third video in the series. Let me know in the comments what you guys think about it, and I'll catch you in the next video.